We came into this space. Again, the market's hot. We saw it. Ray jumped into this thing back in '07. The total number of burrito shops in the business, including Mod and Qdoba and Moe's and Taco Del Mar and the like, was less than 500 units between all the brands. Ray took the approach of second mover advantages. Let's study them. Let's find out their weaknesses, and let's trump them. He went with almost twice the number of ingredients. He went with dozens of sauces that allowed people to flavor the product any way they wanted rather than accepting it the way Chipotle or Qdoba defined it to be offered. We allow people who like sweet to have sweet and people who want creamy to have creamy. And because we were a younger brand and we're more nimble, when online ordering came online and we started to see Uber Eats penetrating the big small towns we're in, we embraced it. We were able to turn on a dime, and we've seen stores literally achieve, double-digit percentages of sales, like 20% of sales in third-party delivery. We expanded from the traditional fast casual into our Cantina format back in 2018, and then one-up that this year, the franchisor opened their first store with self-pour alcohol in a Cantina format. Again, I'm showing the pictures. This is head-to-head. Very similar food product, very similar food category. We think we're doing it with more product, with more opportunity in markets where you can get control of an entire market if you miss the boat. You couldn't have missed the boat on Chipotle, but you missed it on Qdoba. And the same thing applies if you miss the boat on Mod or Blaze, which again played out to large operators crossing over to be part of that huge expansion. We believe our second mover advantage is speed. It's variety. We have more variety. We use bigger, faster ovens. Ray realized that those craft ovens that you have in those brands that are hearth-based, gas-fired ovens, you only have 8 or 10 pieces at a time in them. We've got 3 racks of high-speed conveyors with 2 belts each. We can handle the online orders and the third-party delivery without disrupting our in-store customer set. So the second mover advantage allowed us to enter the space, to literally sail in the wake behind the market that was defined by Blaze and defined by Mod, but overcome the customer frustrations with really long lines during lunches and dinners, with disruptions to the service experience when online orders and third-party delivery took off. We believe we're better at it and faster at it, and we have a greenfield opportunity together. Our stores have now achieved velocity. I talked in the beginning about how many years did it take these other big brands to get to 500 units. Well, we're at 112. We got there in about 12 years, but now we're at a store of brand per month. There's 2 franchisors. They're in parallel. They have similar operating and related operating teams behind the scenes. We're going to talk about a multi-brand strategy in a minute, but we have consistently year over year deployed more and more stores, the vast majority with franchisees, but plenty of corporate stores so that we eat our own dog food and try everything ourselves. We hit that remarkable run rate. I think Hothead Burritos achieved $1 million a week in system-wide sales in 19 and combined about $1.5 million per week. So we have critical mass. We're marching towards that 200. We want you to join us for the race to 200. If you're doing well in your brand, that's great. Take away some of these ideas, maybe put the pedal to the metal and really start your expansion. But if you are on the fence or you're in a brand that's landlocked, you can't put any more stores in, you don't want to drive more than 50 miles, I'll show you in a minute how you can join our brands, double down with the flexibility and optionality of pizza and Mexican, and I'll make the case for why you want those 2 categories. We have commitments from our area developers in about 15 states nationwide that literally, if they stay on track to their 1 to 3 stores a year commitments, we'll get to 700 stores in a number of years. But 200 stores is like the 3rd step on the ladder. We believe we can get there in the next 2 to 3 years, and I think you want to be a part of it. I'm investing to be a part of it. That's what my business is about. So let's talk about what happens when you get to 200 units. The private equity firms and the aggregators that I talked about at the beginning, and which have done all these deals these last several years, they are chasing cash flows. They're trying to grow their operating margins and their cash flows for their investors. The vast majority of their growth is being generated by buying brands that have achieved scale. It's faster and easier than organically growing stores. I think the statistic is about 25% of their growth comes from the brand they buy opening more units, but 75% of their growth each year is created by them acquiring brands and they tend to focus on brands. I'm talking about the tier one players, tend to focus on brands that have at least 200 units. There are a lot of smaller family offices and private equity players who get involved at 20 and 30 and 50 units. But the reason these big guys are doing it is they're looking for the 200 unit unicorns. They're looking for the rare franchisor who makes it to 200 units, holds the ship together, has a development pipeline out there of maybe another 100 units where franchisees and area developers are selecting locations. And when they go after the transaction, they're looking for profitability, right? It's no good to do sales if you don't have profitability. But when they see the 200 units and they see the revenues and the profitabilities or EBITDA targets, then they go after the entire system. Many examples of this. I'll cite a couple in a minute. They don't just buy the franchisor. Franchisors are very sexy, or the corporate operation, but the cash flows are coming to the restaurants. The restaurants have 10 to 1 or even 100 to 1 cash flows versus the franchisors, which is why any sort of transaction in the future that involves private equity or brand aggregators or public offerings, any of those kind of transactions, and I'm agnostic as to where the brands might go. I'm just saying at 200 units, something good happens, and everybody wins. The franchisor, the corporate stores that the franchisors operate, the independent franchisees who've been in the system, like when my family friend Dan Carney, and my dad was one of the first pizza guys, Dan said they made over 100 millionaires when they IPO'd Pizza Hut, because the Pizza Hut franchisees way back in '68 decided to throw in their stores into that IPO and became instant millionaires in like 1968. So franchisors win, corporate stores become part of the deals, independent franchisees who choose to throw in, they don't always, but some do, and the area developers that control markets have a lot of leverage when those kind of transactions occur. And as I summarized over on the left, the drivers are basic fundamentals, blocking and tackling. We've got to have store opening pipelines. We've got to have velocity of store openings. We'll talk about AUVs in a minute. $1 million plus AUVs are critical because it gives you flexibility on rents. It gives you flexibility on payrolls and costs. And those strong bottom lines are let's call it a threshold by which you are judged. And lately, the high percentage of off-premise has been a very fashionable driver in these acquisitions. I've even seen, we've all noticed brands like McDonald's and Burger King remodeling to very few interior seats because they are food factories. I think QSR Magazine this month had an article about they're introducing effectively Siri for ordering food through the drive-through lines because it's more reliable than humans. We are not, in our particular business, driven by drive-throughs. Our business is not particularly well suited for drive-throughs, but third-party delivery, if we can figure out how to do it more profitably, has become a very substantial part of our business. And in the Mexican space, as pioneered by Chipotle and Qdoba, catering is a big part. So catering is off-premise. Third-party delivery is off-premise. Again, what happens at 200? Everybody wins. Nobody individually is trying to make it happen. We're all collectively working to get to that 200 units. Here's some examples of transactions that were not public offerings. Sonic, it was a recent one. I didn't realize it had occurred. That was a Rourke Capital deal under one of their smaller brands. Brands like Rourke are so big at $4 billion in assets that typically they have sub-brands, sub-units that try to incubate these smaller brands. It's hardly, you could say incubate Sonic, but get the deals rolling, bring them in-house and get control. JAB has been acquiring everybody in the planet to get control of coffee and go head-to-head with Starbucks. But the valuations on these deals are substantial. A Pizza Hut family friend of ours sold all of his Panera Breads into that JAB deal, and that was his retirement at like 79. Popeyes, right? It's been around a long, long time. It's still out there. It's still happening. An RBI example doesn't necessarily control the franchisors, although it might in this case. But again, a series of deals. These are billions and billions of dollars of capital flowing into the space. My goal is to get out in front of that, to open as many stores as humanly possible, to do it in a multi-brand strategy. And by the way, I left this Portillo's down at the bottom, which is they branded as a hot dog place when I grabbed this little announcement of it. But even people like Berkshire Hathaway are in the space going for these brands. At 38 locations, that operator, that franchisor effectively traded at $1 billion valuation. Again, I'm just a humble franchise store operator. I want to operate as many as possible, but this is where the exits come from. I saved this from another presentation. These were actual IPOs. Now, what's really telling about this is that the Freshie deal, which was a Toronto Stock Exchange deal back in 17, they only had 244 stores. They were double our size. They sold essentially 10% of the company got valued at $1 billion. It's fashionable. It's just fresh food, salads in a box, and rolls and bowls. Fatburger, right? Fatburger at 200 units raised $24 million in what was effectively, I believe, about a 10% stock sale. They've since leveraged that to buy Bonanza Steakhouses and others. Again, for those of us who are franchise store operators, do we really care what's going on at the high level? Well, yes. The reason we care is if we're part of a brand where that sort of thing happens, the tide rises or raises all boats, as they say. So we want to be part of that. Shake Shack, they had astounding AUVs because almost all of their stores were in Manhattan. Again, an acquaintance of mine was the chief financial officer on that deal. He said it took a lot of work to convince the street that they were not going to do $4 million when they got to Dayton, Ohio. But that brand has continued to open stores at a blistering pace. Yeah, their AUVs are falling off, but they still raised $100 million on a minority share sale of the company into an IPO at 63 stores. This is possible. Opening 60 to 100 stores a year is possible. Getting a substantial transaction that doesn't create the retirement of the people in the brand, that creates the upside opportunity to be part of a brand growing to 500 to 1,000 stores, like my brother grew with Subway over the years, and many of our operators did. I'll stop going into the details, but Wingstop, you can look them up yourselves. Again, 25 years old almost as a brand. It was just 4 years ago they did their IPO. They are trucking along. All of these brands, with maybe the exception of Freshie, are experiencing decent AUV growth. They're stable or increasing. Same-store sales stable or increasing. And we're going to talk in a minute about the fast casual market. We look forward to helping you. If you're interested in getting in touch with either brand or with us, you can certainly reply to the invitation. The invitation will cause you to get a link to a recording. If you enjoy the recording, you can certainly share that with your friends. You can also, again, go to our YouTube channel. Just search for Wiley Development Group on YouTube.